Hallo und herzlich willkommen bei valueCampus. Schön, dass ihr wieder eingeschaltet habt. Über 90% der Fonds performen unter ihrem Vergleichsindex. Eigentlich ein trauriges Ergebnis. Wir haben heute für euch den CEO von Turtle Creek interviewt, der zu den wenigen Fonds gehört, die den Markt schlagen, nach den Grundsätzen des Value Investings wie valueCampus investieren und auch mit eigenem Geld investiert sind. Warum Turtle Creek so erfolgreich ist und wie Turtle Creek erfolgreich durch die Krise steuert, das haben wir heute für euch in diesem Interview dem CEO Andrew Brenton entlockt. Viel Spaß beim Zuschauen. Andrew, we are very pleased to have you on this interview. And I would like to ask you to give us a short introduction to Turtle Creek, your firm, which you have founded with your two co-partners, 22 years ago.
Sure. Thank you, and really happy to have this conversation. It's true. We started Turtle Creek 22 years ago. And I'm in the office right now doing this interview. And at some point, you may notice over here a person walking back and forth. That would be one of my two partners. So we started Turtle Creek in 1998. And prior to that, we set up and ran. So we began and deployed money for one of the large Canadian banks. In Canada, we have essentially 5 very large banks that dominate the banking market here. And one of the banks asked us to run a private equity fund for them. And we did that in the 1990s. We were successful as private equity investors, but we decided for the three of us, myself and my two partners, that we would rather spend our time investing in public companies. And I'm happy to, as we talk, we'll discuss some of the reasons why. But we essentially started that 22 years ago. We're still at it full on today. All that's changed over the years is that we have built up a larger investment team. We now have 12 professionals on the investment team. No one yet has ever left Turtle Creek on the investment team. And what that does is it allows us to simply follow, have a view on more companies. But the essence of our investment approach hasn't changed in the 20 plus years.
Yes. And I have to add to that, I think, and also to our audience, you have a very successful track record. I think you have, over the 20 years, a compounded return of over 20%, which is quite remarkable, and approximately $3.5 billion under management in 3 funds. Is that right?
Yes, although the majority of that money is in what I'll call our main fund, the original fund, which you could think of as a North American public equities company. We, as I explain our investment approach, we've yet to go to Europe looking for public companies. We're still busy in the United States, but someday I know we will look to Europe. Having said that, of course, most of our companies, many of them have significant operations in Europe.
So US, Canadian companies with European holdings, which is, I think, allowable in 2 funds of the 3 funds, and 1 fund is not restricted to any regions for direct investments. Is that right?
That's right. So the main fund, what I refer to as the original fund, has no restrictions. So we have a Canadian-only fund for investors who just want Canadian public companies. We have a U.S.-only fund for people who want U.S. only, and then we have the main fund, which is it can go anywhere. it hasn't yet gone beyond North America in looking for companies.
Yes, interesting. So, and your investor base is really made up of family office, high net worth individuals, and institutional investors.
Yes, and mainly Canadian, given we're based in Toronto, and I think it's natural that you first have investors in your home market. But we are increasingly having interest in having investors from many European countries. So it's actually nice to see that the first time I, as Turtle Creek, ever went to Europe, not to see operations of our companies, but instead to meet with investors, was, I guess, November of 2019.
In Luxembourg.
And we plan to come back more recently, but of course that won't happen until the pandemic is over.
Yes, and we have actually to thank Christian Freischütz, who organized, I think, the Value Investing Conference in Luxembourg in 2019. He's actually looking for organizing something in the near future, maybe after we can all meet after the pandemic again on a physical basis. So, and I think that's also the purpose here with valueCampus and Turtle Creek, to give your investor communities and Turtle Creek the opportunity to have the chance and exposure to German investors, Austrian investors, and Switzerland investors. So, very good. From sector specific, I understand you are not so much limited on any sector. I understand you try to avoid certain sectors. Is that right?
Well, we do. And so we've never owned what I will call a basic resource company. And I always emphasize that, because international investors, when they look at a Canadian-based manager, would assume that they own resource companies, so energy companies, mining companies. We never have. It's not sectors that we know very well. There are a lot of investors who come to Canada to look at those sectors. So we thought when we began Turtle Creek, we just wouldn't pay any attention to those sectors. And if you think of our previous careers in private equity, a Toronto-based private equity fund generally would not look at oil and gas and mining either. So it's just never been an area that we look at. But what I'd say generally is there are other sectors that we prefer not to look. An example would be a biotechnology or drug discovery companies. I don't like the structure of the industry, and they're very difficult to, I guess, understand. We'd like to find companies that aren't actually that easy to understand, but are understandable to someone who's not an expert, for example, in biotechnology. So another example more recently would be, I don't know if your investors in Germany would know about this, but Canada legalized cannabis or marijuana a couple of years ago, and there was a small bubble, a frenzy of valuation. We don't want to be investing in new industries where some companies can raise lots of money and then do stupid things. We'd rather be in industries that have been around for a while. So that's, but very much we don't think of ourselves as sector specialists. For us, it's all about finding a great company. If we think we found a great company, we'll then learn about their industry. We'll learn about them from them over a period of time.
I think that's very typical and I think a classic for value investors. And I think we will come back later to that, what special kind of value investing Turtle Creek is executing. In what times of company size are you navigating in terms of market capitalization?
Well, it's interesting. It's what I would call what we call here the mid cap or middle capitalization. So that's roughly 2 billion, and I'm speaking now in US dollars, $2 billion market cap at the smaller size, roughly 25 billion at the upper end. But that's just a framework when we're looking for companies. And frankly, we have never noticed a difference in the term, of course, is efficiency of the market. Regardless of the size of the company, whether it's a $40 billion market cap or a $1 billion market cap company, we've not seen any difference in terms of how efficient the market is. So to some extent for us, we need to be an important enough shareholder of a company that we can have direct conversations with management. That doesn't mean we need to own 6 or 8 or 10% of the company, actually. I'll give you a great example. One of our holdings, we think it's a remarkable company. It's an American company called Borg-Warner. They're actually very strong in Europe. Their biggest customer, their business is essentially powertrains for every OEM automotive company essentially in the world. Their biggest customer, I believe, is still Volkswagen. They announced an acquisition yesterday, and I'm going to forget the name, but a German company, and that is a leader in electrification for commercial vehicles, not for cars, but commercial vehicles, with significant business with all of the German auto manufacturers. And having announced that acquisition, we were able this morning to have a Zoom conversation, a Zoom call with the CEO and the CFO to talk about the announcement, why they're doing this, how it fits with the rest of their business. And so if you think about it, if Google were to announce a significant transaction, given the size we could never have that type of one-on-one conversation with Google management. And so in a way, the market size of the companies is partly a reflection of how much money we're managing. And with Borg-Warner, I suspect we only own 2 or 3% of the company, but it's enough to be on their list of people, their owners, who they would then have a 1-hour conversation with when they make that sort of announcement. And that's a critical component of our investment approach.
Yes, and that's also our philosophy as value investors. Management is a critical factor. And I think, Andrew, this must feel very comfortable for you still after your investment banking and private equity background, still to have the chance as a public investor to talk really to management. I think that must make you very comfortable with investment decisions.
You're right. And, thinking back to last year with the pandemic and during March, the lockdowns and the pandemic hit Europe, of course, sooner than it did North America. We were able to have conversations with executive management of every one of our companies. And it's easy in hindsight to say, oh, well, Turtle Creek bought more shares of these companies as the prices were falling sharply in March. We've done the work ahead of time. We have a view of what those companies are worth. The margin of safety had become larger. And we would say, of course, we would have bought more of them. But It's a lot easier to buy more of a company in the middle of a recession, a lockdown, a pandemic, when you've been able to speak to, for example, the CFO to make sure that there are no liquidity issues, that there's no covenant issues with their lenders. And given the relationship we have with our companies, we were able to have those conversations with all of our companies.
Yes, that's great. So the pond you are fishing is really the mid-cap space, I understand, and your strategy is a buy and hold, or is there anything special in addition to Turtle Creek?
Well, we have our corporate catch line. I don't know what the equivalent term would be in German, but our corporate slogan is a different kind of value investing. And one of the ways that we're different is that we are not a buy and hold. Or maybe the way I would say it is our intention is to be a buy and hold unless something changes. And most often what changes is the share prices of our companies change. And so, we think, for example, if 5% of your fund is in a company and you feel comfortable that that's the right percentage, and then the share price falls because they have 1 weak quarter of results, and the share price falls substantially. And that happens a lot in the US especially. Or even sometimes the share price just falls for no clear reason. We think doing nothing, just saying, well, I like the company, I'm not going to do anything. To us, that doesn't make any sense. We think that if the share price has declined and nothing has changed in your view of the company, then it would be not logical to simply not buy more shares. In fact, if it were to decline enough in price, not only should you buy more shares, you should buy enough shares to make the percentage more than 5% of the fund. And that's what we do on a continuous basis, and we call that a continuous portfolio optimization. So we're changing the amount we own of each company simply in reaction to the public market constantly changing the value they put on the company. So our view is true intrinsic value or business value changes very little over time. The share price, as we all know, changes often and a lot. And in a sense, we take advantage of that. I sometimes feel like we were attracted from private investing to public investing. And one of the reasons was this feature of remarkable share price volatility when the underlying business value is not changing very much at all.
Yes, especially I think in times when we have seen the private equity space, very high-priced companies, due to the fact that there is a lot of money in the market, also a lot of dry powder for private equity, and there was no volatility at all. The prices could only rise. And as you're saying, if I get you right, in the public market, it's much more subject to volatility and gives more bargain opportunities. Is that correct?
Yes, for sure, that's the case. One way to think of it is the private equity transactions are at control, like for the whole company, or a control price. And for all of our companies that are trading, we have a view as to, well, if they were purchased by private equity or if a competitor bought them, what would they pay? And that's our intrinsic value or the business value. And so that is that intrinsic value that doesn't fluctuate all that much. And again, it's exactly what you said. We know we could never buy all of any of these companies at the price we're paying at any point in time. But that's okay. We don't want to control the companies. In essence, we went from private equity investing, where we did control the companies, where we sat on the boards, where management would come to us and say, "What should we do now?" And we thought, no, we'd rather go and find remarkable companies that don't need us to tell them what to do, where we can just ask questions, or maybe at times we can contribute a view in some way of value when it comes to finance, but never to do with their business. And believed that there are, in essence, what I would describe as remarkable companies that are public that are hiding in plain sight. One of the things, and I think it's a misunderstanding for most people as to why public markets exist, why the stock market exists, is to raise money, is for a company to raise capital. And of course, that's one reason that a company is public. But frankly, I think the more common reason that a company becomes public is as a source of diversification for the original owners. And so one of the characteristics we're looking for as we look for public companies, we obviously want them to be great operators and honest. But another feature that we really think is important is that they don't need to sell shares to raise equity to run their business. That, in other words, they're self-funding, and so that it doesn't matter if the share price is low. They can still continue to grow and run their business. And our experience is sooner or later, if it's attractive, the public market will notice. But sometimes it can take years for that to happen.
Yeah. Andrew, that's very interesting. Maybe we flip back a little bit to the one assessment where you said back your COP, so continuous optimization process. So does this also refer, in this kind of Fed pushed market where we have a very high price valuation or very high prices in the market for assets, have you also occurred in your portfolio where you've seen the prices have went far up about your original intrinsic value and then have adjusted accordingly? What you mentioned earlier was, just buy more if the shares are dropping. Have you also exited and went in cash during 2020?
So the one thing I would stress, and thank you for bringing it up, because I want to emphasize the symmetry. It's all well and good to say, I'll buy more of a company when the share price goes down. But then you would ask, where do you get the money to do that? And so we are equally eager sellers as we are buyers. There's a perfect symmetry in what we do. So we actually we try to be fully invested. We don't like sitting with cash. We just simply own companies. And the fact that they're public is just almost an afterthought in a way. We just want to be an owner. We want to have our capital working and invested in companies. And we've never had, since the .com, since the spring of 2000, we've never had 10% cash in the fund. So it will fluctuate at its average 2%, 3% cash in the last 5 years. But we are targeting to be essentially fully invested. But that process of trimming and adding, like I said, is symmetrical. So if you think of a company where I was mentioning, if you own it and it's 5% of the fund and the share price declines for short-term reasons and your view of the intrinsic value hasn't changed, then we would say, of course, you need to buy more shares. And at a point, you need to make it a bigger percentage than 5%. But that also applies the other way. If a company is 5% of your portfolio and they have a good quarter, they have good results, or the market in that company, maybe that sector becomes popular in the stock market, and the share price goes up. We equally feel like, as much as you may like the company, you have to sell shares. You have to reduce the holdings. You can't let something become a bigger percentage when, in essence, the margin of safety has become less, or when that means, of course, that your long-term expected return at that price is now lower. So it's very much a symmetrical process. And there are plenty of examples of holdings, to your question, where the share price has gone up and gone up and gone up. And at a point in time, as we're trimming, it essentially is removed from the portfolio because it just rises. And a couple of examples where in the last 3 or 4 years, a holding has been out of the portfolio and back into the portfolio, but then back out of the portfolio. And you mentioned the high valuations in the current market. You're absolutely right. We've been around long enough. We lived through the last frothy period, which was, of course, the late 90s and the dot-com. And I feel like every generation needs to learn the same lessons. And I think we're living through that type of period again. But from our standpoint, nothing's really changed. We look across let's say the 100 companies that we follow. We don't own that many companies. We own today 28 companies in the main fund. Many of the companies that we used to own, that we're following, we have a view of intrinsic value. Many of those companies today are trading above and sometimes well above our view of their intrinsic value. And that's okay. It's not surprising, perhaps, in this market. The important point is we don't own any of those companies. They can be great companies, but of course, they're trading at more than a great price.
Yes, now I understand better your kind of symmetric approach to risk management and really to de-risk your portfolio. That's very interesting. And this brings me to the next question. Can you describe to us, please, how you navigate the potential market sell-off, or have you already answered this question? I think if you're following strictly a risk management approach, as you described, you must not have any fear about a sell-off.
We really don't. And one of the greatest difficulties that I have is explaining to investors. You mentioned our strong returns, and that's true. They're strong returns, but we've all been taught, well, if someone has high returns, there clearly must be taking a lot of risk. And the most difficult aspect of what we do is trying to explain to people, we're not trying to make those returns. We're actually, in essence, constantly trying to build the lowest risk portfolio from the companies that we've identified. So clearly you could find some remarkable lower risk common stocks, maybe utilities that are very regulated, but from the companies that we have identified, we're simply then trying to build the lowest risk portfolio. And our view is one of the key ways you do that is you own more of something when there's a greater margin of safety, but you have the discipline to own less when there's a smaller margin of safety. And when there's no margin of safety, you shouldn't own it. You can continue to follow it, but you shouldn't own it. And so, when you ask about a market sell-off in 2021, well, I can tell you what we did in 2020, because there was a heck of a market sell-off in 2020. Early in the year, our unit price was at an all-time high. The market, of course, at least in North America, the markets were at an all-time high. And as a result of our trimming, that optimization, we happened to have 7 or 8% cash. And it's not that we had that much cash because we saw a market correction coming. We don't think that way, but a market correction came, a brutal market correction or crash in March. And we had the opportunity to deploy all of that capacity into not all of our holdings, but some of them that fell the most. And then through the year, as things recovered, what was nice is they didn't recover evenly. I mean, generally, in a crash, everything falls. In a recovery, things recover at different times. And that allows us to trim from a holding that has, let's say, fully recovered by the summer, and take that cash and deploy it into one of our other holdings that at that point had not yet recovered at all from the crash in March. And again, that's this concept of continuous portfolio optimization, but it really is risk management, risk minimization, not trying to make higher returns.
I think that sounds very logical to me, and is a very smart approach, I think, to value investing and a specialty of Turtle Creek. Andrew, do you have, I think you make a lot of things right. You have an outstanding performance. Do you have, or do you remember any mistake you have made that might be an enduring lesson for our audience?
Well, I'll talk about a big mistake, but first I'll say, I think one of the keys to good value investing, and what I mean by good is, there is that dichotomy. Someone sent me, I'm sure your group has read Howard Marks' memos or letters from Oak Tree, and I haven't.
Yes, January 11.
Yes, and he's written a new one. I don't know when it was released, but someone sent it to me today, and I read the first page, and he's talking about the difference between, or is there a difference between value investing and growth investing? So, I would say one mistake that we've never made, in a way, is to not be too conservative. I think being overly conservative in assessing a company's future prospects is as bad as being, overly aggressive and getting carried away, getting excited irrationally. So I think, an important feature of good investing, whether you call it value investing, whether you call it growth investing, growth in a value sense, cash flow and intrinsic value, that, what we do at Turtle Creek is we say we're trying to get the future right. So if I use, I'd mentioned BorgWarner already, and they've made this $1 billion acquisition that's not profitable. At least it wasn't profitable last year, but I believe it could be quite profitable this year. Maybe a traditional value investor would say that doesn't make any sense to me. But if you look at it, if you talk to the company, if you understand the lead that this company has with all of the German OEMs, and that they can bring to the United States and bring to other places in the world, our view is you have to try to take your best guess at what that company will generate in revenue in 3 years, 5 years, 10 years, and how it will contribute to BorgWarner overall. So I'd really stress that as an important feature. I think that I often hear value investors say, I make really, really conservative assumptions. And then if there's still a margin of safety, I invest. And I think at least our approach is to say, let's try to make the right assumptions. And then our conservatism comes in, as we were discussing, that when you have a big gap between that value that comes from balanced assumptions and the current price being a really big gap, you're protected in case maybe your assumptions were a little too high. But what I'll do now is tell you about a big error that I made and what I learned from it. The good news is it was a long time ago. It was in the early years of Turtle Creek. And I've actually mentioned biotechnology already. I'm not comfortable with biotechnology, but I actually really like the other end of the drug industry. So it's called specialty pharmaceuticals. Essentially, that means smaller companies that will license in or buy more mature product from big pharma and just do a better job of marketing it, talking to the doctors, selling it. And that can be a really good business. And there was a company in Montreal that we met who said all of the right things. And I loved that sector so much. I dragged my partners into the investment. I said, boy, this is a great industry. And we did, it was not a big investment, fortunately, until doing more work with them, spending more time with them, we realized they're saying the right things, but they're not doing any of the right things. And I remember that feeling in my stomach. We were sitting in their boardroom in Montreal, and I looked around at the management team and I thought, this isn't good. They're not good at what they're doing. They're making mistakes. We didn't
not walking the talk.
Exactly. And we did, and it's the only time that we just simply sold a position. Our approach is, if we change our view on a company, it tends to be little bits, so that we have a term in English called whipsaws. We don't get too excited and then too down on a company. But in this instance, we just thought this was a mistake. It was my mistake of again, not thinking that it was about the company, that it was about the industry. And so we did lose some money on that. But it was a very valuable lesson, because it's what I said earlier in our talk. We don't ever say we want to, well, not since then. I'd love to find a company in the specialty pharmaceutical space. We need to meet a company that is potentially remarkable, and then we will learn about that company. And just to finish that story, ironically, a few years later, we met a Montreal based specialty pharmaceutical company that we ended up owning. It was very well run. It was run by the founder, remarkable company, and we did very well on it over the years. But it just was so that mistake of, don't ever say, I want that sector. You have to find a great company, because it doesn't matter. You saw that in the .com, the number of sectors that had great growth, but no one made any money in it because companies did stupid things.
Thank you, Andrew, for this very honest reflection of a mistake, I think, which happens in an investment career. Not so often. Your 20% plus compound return, I think, pretty proof of that. That brings me to more or less to the last question. Is there any in particular keeping you up right now, awake at night, that doesn't make you sleep, i.e. the market, or the pandemic and the market, or the money flow in the markets? What keeps you awake at night?
Well, when I'm asked that question, I sometimes joke. I kind of worry that I'm not worried. But I remember the story when I met with a couple of our investors back around the time of the credit crisis, or maybe a little bit after the credit crisis. And our unit price, of course, it fell with the market, but it also recovered a lot faster than the market. And when I would meet with investors, I would say to them, because they would go on and on about the market crash and the credit crisis, but they would own a company. And I would ask them, I said, did you worry about your company in 2008 or in the Great Recession in 2009? And they'd pause and they would say, no, I didn't. And so there is this funny effect that, because there's information that we actually don't think is information, that price information, price discovery that is referred to by the academics, a lot of times it's just simply noise. And so what keeps me up at night is when something bad has happened to one of our companies. But as long as we think about that bad event and say, look, bad things are going to happen to companies, and as long as management then had plans to deal with it, it's okay. We many years ago owned a company that was a leader in making pet food. And one of their suppliers in the United States, against explicit instructions, sourced an input from China, and it was laced with, I think, rat poison. And as a consequence, some animals died, some pets died. It was front page news. It was a very, very bad event for the company, but they managed through it. They did a remarkable job because they were not ultimately at fault, and they worked through it. Or a few years ago, a Canadian small financial institution had a funding crisis, and we were a large shareholder, and they also managed through it. So those are, I wouldn't say keep me up at night, but those are not comfortable experiences. And but again, if you own strong companies, they will deal with unfortunate events. In both of those cases, they did. In terms of worrying about the market, I don't. I worry about exogenous events. I worry about North Korea doing something stupid. I wasn't explicitly worrying about a pandemic, but I'll worry about that now happening again. But with regard to our portfolio of companies, and I should have emphasized this at the beginning, we own companies that have very strong balance sheets. All of our companies in the credit crisis in 2008, 2009, had the strength of balance sheet to make it through to the other side without issuing equity or having to reorganize. All of our companies powered through the 2020 and the pandemic. If anything, are coming out the other side, because we're not done yet, stronger than they went in. So I don't really worry about the market. At the end of the day, what I'll say to investors that that our unit price is higher today because there was a credit crisis. If there had been no credit crisis, our unit price would not be as high as it is today. Our returns would not be quite as high. And I can now say the same thing about 2020. I'll be able to say down the road, if there had never been a pandemic, our unit price wouldn't be quite as high as it is because of that overlay that we have, because we own great companies, but then we try to add value through our continuous portfolio optimization. And whether it's the credit crisis or now the COVID crash in March of last year, those to us are simply opportunities to improve upon a buy and hold return.
Yes, it very sounds like, Andrew, that you are prepared for any shocks coming on the table. So that's very...
Yeah, I'd stress that it's finding the companies that they themselves are prepared. Because so that's 90% of it. I will say honestly, we marveled at how well our companies handled last year. So
yes, that's great news, I think. And to wrap up the interview once again in a nutshell, how would you describe Turtle Creek's edge for true market outperformance in terms of buying and valuations and reacting activity?
Yeah, so again, coming back to that concept or our tagline of a different kind of value investing, I think the main differences are we're trying to find uniquely remarkable companies that are understandable, but maybe hard for the public market to understand that there aren't 5 of them that are all similar. So that's a step. I've talked about how we're different, I think, when we forecast the future, we try to get it right. We don't try to be conservative. And then I would say, and I continue to look for other groups that are anywhere near as active as us in rebalancing the portfolio, and at least in the way that we do. And we've yet to find anyone. So I think those are the the real key differentiators, at least in terms of groups that we've met so far. And we hear that from groups in Europe that evaluate managers, or groups in the United States now, as we have U.S. investors, that they haven't seen that last element, that rebalancing activity that we follow from anyone else.
Yes, and I think this is unique, and all your outperformance, I think, is on your side. Thank you very much, Andrew, for this interview, for your time and your interest.